Hey folks, Dan Frio here, the rate update. Today is September 30th, 2020. Last day of September. Tomorrow starts a new fee if you're looking to refinance. So what happened today in the markets, and did we prep in good time for this fee? And when I said the other day, pigs get fat, hogs get slaughtered, I'm looking for a pullback in mortgage-backed securities. What happened? Don't go away. That's what we're going to talk about. So if you follow my channel, you've been hearing me talk about a fee that's coming in, that's getting put in place by Fannie Mae and Freddie Mac. Those entities are called FHFA. Okay, I'll just leave it at that. It's an FHFA fee. They're coming in and saying we're going to charge 0.5% or 0.5 point on any refinances over $125,000 that are not Home Ready and Home Possible loans. If you don't know what Home Possible or Home Ready loans are, let me know and I'll let you know if that affects you or not. This is what I do. So most mortgage advisors don't know all the details of this. They're just going to say, rates are going up, fees are going up. If you want to hear about some of the comments about this fee, just click down below. I was featured in MSN and Yahoo Finance. They reached out to me and asked me some questions in regards to this and some other articles that just were recently posted. And then, last month I was featured in there as well. So they're reaching out to me, and I'm thankful for that, to give them some guidance and expert advice on the mortgage market. So that being said, I locked in basically everybody between Monday and Tuesday. The reason I did that was, and I'll show you that here in a second, is on Monday. If you go back to my Monday's video, I said, don't get slaughtered. Pigs get fat, hogs get slaughtered. You're never going to time this market perfect. Neither do I. Many times I hit it pretty darn good, but I don't. Like I said before, if you hit this absolutely perfect, you're probably going to go to jail because you're insider trading and you know something that other people don't. That being said, I'm going to go over with you here shortly what happened in the MBS market. What the MBS market is, and here's why I follow this. It's basically the tool that is determining mortgage rates. It's the investment. It's a bond that trades that is the biggest piece or biggest factor in mortgage rates. You take that along with the bank's profit margin, along with risk-based adjustments such as, is it an investment property? It's a riskier loan. Are you pulling out a bunch of money out of your home, driving up what we call the loan to value of the property? That's a higher risk for the lenders. So there's a whole bunch of risk-based adjustments. So what I try to do on here is just give you the generics of things. So what happened, let's go and see what happened today in today's market. You're going to notice right here that this number is a red 8. And I'm going to say this just to make it as simple as I can, and we won't dive into it real thoroughly. I don't know if that made sense. We won't dive into it so I can confuse you. When you see a number green, that's good. That means rates are going down. If you see a number in red, that's bad. That means rates are going up. Okay, that's my easiest explanation on how that works. So we go through and I follow all these patterns. And this is basically how the MBS market has been trending the last quarter. And I follow this meticulously. Every day I read all the reports that come out every day on multiple email sources. I share this newsletter every day with everybody in the markets. And so this is basically what's going on. I don't care what you follow. If you follow stocks, you follow, like I was saying the other day, if somebody's baseball hitting, their ERA, their if you're a golfer, you chart your what you're doing with your scores. This is basically charting every day what happens in the mortgage-backed securities market. And again, up is good. Up means rates are coming down. Red is bad. So this is where we are. These levels right here, and I put green lines in there. Those are what we call Fibonacci levels. They're ceilings. This is a long-term ceiling, long-term floor. Short-term ceiling, short-term floor. Then if you want to even dig in a little further, we have, and I'm going to get rid of this right here. We have what this number has done, what the number has averaged over 25 days, 50 days, and 100 days. And that's what the DMA means. 100-day moving average, 50-day moving average, 25-day moving average. So and you can go back again and watch my videos. I expected us to trade in this range right through here. Okay, and the reason being it's in the middle of all these. It's a make sense number. It's hitting some certain trigger lines here. So that's where we're kind of pegging things right now. And the Fed is doing a fantastic job on keeping stability at this range right here. So you're going to see we go below it, and then we come back up to it. And then we go above it, then we come back down to it. We go below, and see how we just keep bouncing around. Well, in the past week, this number has gone up, and there's really no apparent reason for it other than the speculation of a new coronavirus or pandemic bailout, and that's why I think it pushed this up. And now this is where a little bit of micro stuff comes in line. But you see right here, we hit the ceiling, the short-term ceiling right here, and we stopped. We did it again today. The market opened way down or mediocre. Then we dropped 19 points, and then we came back up to almost back to par, meaning back to where we started. All right. I'm expecting us to trade back in this level soon. So when we hit this yesterday and we hit that line, I was like, or Monday, I'm like, I'm going to lock everybody in, because based on that, based on the election or the debate last night, and I knew employment numbers were coming out today that I thought they were going to be better than expected, which they were. That prompted me to go on the side of caution. I'd rather be a pig than a hog. I didn't want to get slaughtered, I guess is the best way to put that. So I locked in everybody. That on top of tomorrow is when most lenders are implementing the new fee that's coming out by FHFA of a half a point. A half a point is basically take your loan amount and multiply it. So say 250,000 times 0.5%. Whatever that comes out to be, that's the new fee that you're going to be charged no matter who you go to. Because FHA and Fannie Mae and Freddie Mac are both implementing this, and they do almost all the loans throughout the whole country, or 90% of them. It doesn't matter if you go to me, Quicken, Wells Fargo, Bank of America, guaranteed rate. We all get our loans or put our loans through Fannie Mae or Freddie Mac. All right, so that's what's happening right now in this charting section of things. So now let's go to what news came out today. Well, basically, the news that came out today was employment numbers. We were expecting, or the analysts were expecting, that there to be 650,000 jobs created in the month of September. Well, it came in at 749,000, better than expected. Okay, that's what I thought. I'm going to leave everything else the same. So, as I always say, as news comes in that's good, it's good for the stock market normally. It's bad for the bond market. Mortgages are a part of the bond market. So if the economy is cranking on all cylinders, you're going to invest, you're making money, and you're going to invest in the stock market. As you get older, you move some more of your assets into bonds. It's a more secure investment. All right. If there's uncertain times in the markets or in the economy, again, you move out of stocks and into bonds. Mortgage-backed securities are the bond market, and you get lower returns, but they're usually a steadier investment or a rate of return. Even though it's smaller, you know you're going to get something. Okay. So, as we get better and better and better and better news in the economy, you're going to see rates go up. I don't care what the Fed says. The Federal Reserve controls the federal funds rate. The federal funds rate is basically what the interest rate banks charge to lend to other banks. Not to lend to you and me for my car, for my credit card, for my student loans, for my mortgage. Just what they lend to each other at that rate. Okay, so that's what the Federal Reserve controls. So that's what happened today. The employment numbers came in better than expected. So we go back through here again. There were 650,000 people that were expected to get jobs. 749 actually got them. Gross domestic production was, the GDP is at a negative 31. So we're at negative 31.7. We only came in at negative 31.4. That's a terrible number. I'm not laughing, but it's like it's bad. Pending home sales, that is gangbusters. So if you're still renting, I jump on this bandwagon because I don't foresee a crash coming in the housing market. A crash. Will there be a pullback in pricing? Probably. Is there going to be a crash? I'm not expecting it. Check out my channel and you're going to see a video that I did, and I think I actually put an ebook in there. If I didn't, I'll try to figure out a way to how to add my ebook into that video so you can download that and read that. The next 2 days, we're starting to get consumer consumption, personal spending, factory orders, and everything of that sort. This should be a non-market mover, so I don't see anything there. Today, again, here's the headlines. The market that drives mortgage rates just had its worst day in weeks. Pigs get fat, hogs get slaughtered. What goes up doesn't continually go up forever, and there's going to be a correction. So here's today's rates. Midday we had a rate increase, but by the end of the day we were back where we were last night or yesterday. So let's go over where my rates are right now. If you're looking to purchase a house, or what we call rate and term, that means you currently, let's say you owe $250,000 on your home, and you're at 4.5%. You're like, Dan, I just want to refinance that balance. That is what we call a rate and term. You're just refinancing the balance that you owe. Cash out means obviously that you're looking to pull out cash. So where are we with these rates? Well, it depends on your credit score. And this is why I try to tell everybody when they do call in, I'm not trying to keep you on the phone for a half hour. I need the pieces of the puzzle that I need so I can quote you an accurate rate. So let's go through this so I can explain it a little more in detail. If you're looking to buy a house or do a rate and term, up to 80% of the loan to value. And that means loan to value is basically, you break down, you divide your loan amount divided by the value of your property. So a $100,000 loan divided by a $200,000 property is a 50% loan to value. You take 100 divided by 200. If you have a $200,000 mortgage and a $200,000 home value, 200 divided by 200 is 100. Okay, so that's how you figure out loan to value. So at a 740 credit score with an 80% loan to value, the rate is 2.875 with an APR at 2.952. If your credit score is 700, that same particular got those same parameters other than the score, your rate's 3.125. With a 660 score, your rate goes to 4.125. Okay, now if you're looking to pull out cash, so you're like, Dan, I owe $200,000 on my house, but I would like to pull out $50,000 more. Okay, so all these assumptions in here is a $250,000 loan. Okay, and the rest of it is this is your credit score and this is your loan to value. So with a 740 credit score at a 75% loan to value, pulling out cash, you're at 2.99. That same thing with a 700 credit score is 3.375. And if you had a 660 credit score, that rate's going to be 4.625. All right. So that's my easiest way to explain or break down mortgage rates for you. Tomorrow, I will go over all of the conventional financing rates, FHA, VA, USDA, and jumbo. I ran out of time today. I apologize. It was month end. We had a ton of closings thanks to you guys. So I'm running a little short on time. So that being said, I hope you like what you see. What I ask people to do is if you like my videos, please don't forget to subscribe. Give me a thumbs up. Subscribe down below. We're about 50 people short of 10,000. See if you can be the 10,000th viewer or subscriber. I'm going to start everybody that closes loans with us. You're going to get a Pigs Get Fat, Hogs Get Slaughtered t-shirt. And I'm going to try to, I got boxes of t-shirts over here I want to start sharing with you guys. I'm probably going to start picking a subscriber every day, sending out t-shirts to anybody that's, or one subscriber a day. And I promise you I'll start doing that tomorrow. I'll actually pick every day that I do this video. I'll go back in yesterday's video, pick anybody that subscribed. I'll show you. I have a system called TubeBuddy that'll pick our winners. I'll post that right on here. I'll put that down below, give you my email address, and please, I need you to email me back your address so I can shoot you out a t-shirt. And if you want me to send it to a P.O. box or whatever, I have no problem doing that as well. So if you'd like to get a hold of me, and just to pick my brain, use my services. I'm licensed in about 40 states right now. There are a couple that I am not licensed in. Unfortunately, right now I'm not licensed in New York, West Virginia. I'm from West Virginia. Those are two of the states I get a lot of applications from, but I can't help. I apologize. As soon as I can, I'll let you guys know. But if you'd like to reach out to me, the best way to do so is go to therateupdate.com. So that's therateupdate.com. And right down here, there's an 800 phone number. There's me and 12 of my loan consultants. One of us will help you. Just so you guys know, I go through every loan. I review every loan for its program, its rates, its fees. So you're in good hands, I promise you. Give us a call. We'd love to hear from you here. What I ask people to do also on a daily basis is if you're in the mortgage process right now and you have a loan estimate or a fee sheet from another lender, email that to me to get a second opinion. My name is Dan Frio. It's DANFRIO. You can reach me at dfrio@preferredrate.com. That's the best way, probably one of the best ways to get me. But if you want to get your mortgage started, all you need to do is click here and apply now. And when you click there, you can pick me or one of the loan officers, and there's more that we're adding on a daily basis right through here. But pick the loan officer you would like to deal with. There it is. And we've just added 4 new mortgage consultants onto the team. So pick, if you don't know who you're looking for, just pick me. It'll go right to here. You create an account, start the application, complete the application as much as you can. At the end, you're going to be prompted to download a few documents. Those documents will allow us to get you a pre-approval within probably an hour. It's going to be your pay stub, your bank statement, your mortgage statement, and it's all a secured system. We go in there and we dump down your data, we analyze it. If you're not working with me directly, one of my loan advisors takes that data, brings it to me, we analyze it and email you back exactly what we can or cannot do for you. So that's the best way to get us. So other than that, I just want to say to you guys, thank you so much for reaching out, making this whole system a success. We have grown and grown and grown in the last 6 to 8 months. We went from about 2 to 3 million a month. We're doing about 12 to 15 million a month right now, and we're adding loan officers by the week. So thanks to you guys for helping us grow. So that's it for today. God bless. I'll have a more detailed video tomorrow. I'm going to spend about 2-3 hours on this to bring you guys up to date and go over every mortgage or every rate scenario for you guys so you kind of understand the market so you don't get taken advantage of. So God bless. Take care. See you tomorrow. Bye-bye.